Welcome to the Deep Dive, the place where we take complex, swirling stacks of information and distill them into the clearest possible insights for you.
Today, we're turning our focus to the United Kingdom, specifically its economy, which our sources seem to characterize as being, well, fundamentally divided.
A two-speed economy, I think, is the term they use.
Exactly. And in some cases, an economy that's really fighting for its life. We're going to approach this deep dive with a measured, logical perspective. We really want to understand the roots of this national struggle.
And the paradox you mention is truly striking. On the one hand, you have London, a city that generates just staggering, concentrated wealth.
It's a global powerhouse.
It really is. I mean, if we were to isolate London's economic output valued at roughly $652 billion, it would be the 22nd largest economy in the world.
That's comfortably ahead of places like Sweden and Argentina.
Which is just incredible to think about.
Mhm.
And it remains one of the world's most vital financial hubs.
Yet, and this is the core of the issue, if you step beyond the relatively small confines of the Southeast, you immediately encounter this deeply entrenched, chronic socioeconomic strain. We have a mountain of sources here detailing this severe division, and it forces us to ask a calm but critical question.
Okay.
Is the UK's current profound economic struggle merely the unavoidable result of massive external shocks? Things like the 2008 global financial crisis, the COVID pandemic, the war in Ukraine.
And this is where the conversation gets truly interesting. Is it something else?
Is it primarily the cumulative and maybe predictable result of sustained internal political and policy choices?
Choices that, for the better part of the last 40 years, have disproportionately favored one specific geographic region and one specific industry over all others.
That's the central debate. Our mission today is to unpack these sources, to trace the connections between historical policy decisions and the impact of these recent shocks.
So we want to understand how all these factors combine.
Exactly. How they produce the current state of social strain, focusing acutely on the interconnected dynamics of national confidence, immense national debt, and profound regional inequality.
Okay, let's start by unpacking this two-speed economy. Let's try to define the division, visually and quantitatively, because the concentration of wealth is staggering.
It really is. London and the Southeast make up nearly half the UK's entire GDP.
Nearly half.
Yet they house only about a third of the total population. That immediately tells you something is deeply imbalanced. The productive engines are really only running in one corner of the country.
And the quantitative analysis, it reveals just how fragile the national average is because of this concentration.
There's a sobering thought experiment in one of the sources.
What's that?
It says if you were to remove London's economic output entirely from the calculations, if you were to amputate its output, so to speak, it would instantly reduce British living standards by 14%.
A 14% immediate drop. And that number is significant because at that newly reduced level of average prosperity, the UK's living standards would only just manage to slip ahead of.
The average prosperity of the U.S. state of Mississippi.
The poorest state in the U.S.
Precisely. This comparison gives you an immediate, visceral scale of the wealth gap we're talking about, especially relative to the rest of the developed world.
And what's fascinating here is that the inequality isn't just an occasional statistical blip. It's structural.
Yeah.
It's geographical.
It's baked into the system. If you look at the data, not a single region north of the capital has a GDP per capita that reaches the UK average.
Not one.
The average is being pulled up entirely by that southern concentration of financial and service industries.
And the cost of this extreme disparity is tragically human. We see anecdotes in the sources that are, frankly, difficult to ignore. They describe the severity of the squalor, the poor health outcomes outside the capital's wealthy sphere.
The life expectancy figures are particularly shocking.
Yeah, life expectancy in certain neighborhoods in Blackpool, for example, is demonstrably lower than it is in Rwanda.
Let that sink in. We're not talking about a slight deviation from parity here. This is a profound and shocking chasm of inequality within a supposed G7 nation.
So to understand how this division became so deeply embedded in the economic structure, we have to trace it back.
To its historical roots. Specifically, the profound policy shift that commenced around 1979 under Prime Minister Margaret Thatcher. This moment was truly foundational to the current dilemma.
Right. This is the point where the UK pivoted very aggressively away from its industrial and manufacturing past.
Thatcher's government was driven by a necessity to control soaring inflation. It had reached double digits thanks to the 1970s oil shocks and the ensuing wage spirals.
They determined that the only way forward was to crush those inflationary expectations, whatever the cost.
Her approach was highly disruptive and very decisive. It involved radical spending cuts, tight control of the money supply, and most critically, dramatically hiking interest rates.
And we're not talking about small hikes. We're talking about rates rising from 12% to an unprecedented 17% by late 1979.
The highest in modern British history at the time.
So the intent was to make borrowing prohibitively expensive, slow down credit expansion, choke off inflation. And, technically in the long run, it worked.
It did. Inflation fell from 13% in 1979 to 5% by 1983, but that success came at a steep price for places like the North and the Midlands. The immediate cost to the industrial heartlands was catastrophic.
Precisely. Those sustained high interest rates and the strong pound that resulted from them made British exports prohibitively expensive abroad.
And at the same time, it allowed cheaper imports to just flood the domestic market.
So the UK's industrial base, which had been the backbone of the economy for a century, was systematically gutted.
The numbers are stark. Manufacturing, which accounted for nearly 30% of the UK's GDP in 1979, plummeted to just 16% by 1990.
And the jobs.
Manufacturing employment fell by nearly 40% during that same period. It led to just crushing unemployment in very specific areas.
So while these industrial towns were facing joblessness approaching 15% across the north, Scotland, and Wales, something very different was happening in London.
A rapid financial evolution. This is the Big Bang deregulation of 1986. And this dichotomy is absolutely key to understanding the two-speed economy.
So what did that deregulation actually do?
It was foundational. The Big Bang effectively scrapped fixed commissions on stock market transactions. It welcomed foreign ownership of brokerage firms, and it unleashed electronic trading.
So overnight, London was transformed
into a dominant global financial center. Suddenly, it was competing fiercely with New York and Frankfurt. International banks poured in massive amounts of capital. The sources say it minted 1,500 new millionaires and cemented the City of London's status as the global epicenter for finance.
So if you just look at the headline numbers, the aggregate data, the UK economy appeared to grow richer overall. GDP per capita rose by about 30% between 1979 and 1990.
But as we so often see, that aggregate data obscures the vast divergences happening just beneath the surface.
It absolutely does.
And we can measure that divergence using the Gini coefficient, which is the standard measure of income inequality. It's calculated between 0 and 1.
So a score of 0 represents perfect equality. Everyone earns the same.
And a score of 1 represents perfect inequality, where one person owns everything.
Okay. And what happened to the Gini coefficient during that period when London boomed?
It increased by 40%.
40%. That is an enormous rise for a developed nation in peacetime.
It confirms that the shift to financial services, while it did boost overall GDP, massively concentrated the earnings among a much smaller, more specialized group of people in a geographically limited area.
And you can see this concentration when we compare the economic multiplier of the old industries versus the new ones.
Right. In heavy industry, like iron or steel manufacturing, one direct job supported up to 9 indirect jobs in related sectors.
So things like distribution, maintenance, suppliers, local services.
Exactly. The wealth actually permeated the community. It spread out.
And you contrast that with financial services broadly.
Where the sources suggest the job creation ratio is closer to 1 direct job, supporting only 3.6 indirect jobs.
So the actual value generated by finance is high, but the money tends to circulate more locally.
It circulates among highly paid professionals and very specific support services, rather than spreading widely through the broader economy.
This fundamental difference, it explains why the policy shift to prioritize finance, even though it was highly profitable for the country's aggregated wealth, inherently distributes that wealth less widely.
It concentrated economic power among fewer individuals, disproportionately benefiting the South, and leaving the rest of the nation structurally weakened and, frankly, dependent.
And this is where that argument really gains weight. The argument that the current crisis is a consequence of internal policy choice rather than just external shock.
Yes, these deep structural inequalities weren't an accident. They were actively created by decisions that favored London's service industry over the entire nation's traditional manufacturing base.
Okay, let's move now into examining other specific policy decisions that really exacerbated this deep division. Starting with, I think, the housing crisis. It acts as such a major barrier to opportunity for the rest of the country.
The housing situation is absolutely critical because it fundamentally negates the economic advantage that London theoretically offers.
Right. If you look at the raw data, Median household income in the capital is 14% higher than the UK average. That sounds like a powerful magnet for talent.
It should be. However, when you realize that housing costs in London are nearly double the national average, that magnetic appeal just vanishes.
So when you factor in the sheer expense of renting or servicing a mortgage,
That 14% income advantage shrinks to a meager 1% advantage. Just 1%.
wow. So that means that unless you happen to be in the top quartile of earners, moving to London for economic opportunity, it just makes no rational financial sense for a median earner.
None at all. The structural barrier explains why London is one of the only UK cities with a negative internal mobility rate.
Meaning more people move away from the capital than move in.
Exactly. And this crisis wasn't merely an accident of market forces. It was actively fueled by policy choices, most notoriously the Right to Buy scheme introduced in 1980.
This policy allowed tenants in council housing, so social housing, to purchase their homes from the government at massive discounts.
And not small discounts, sometimes up to 70% off the market value.
It was a massive transfer of wealth to one specific generation. It benefited hundreds of thousands of families with an immediate path to asset wealth.
I mean, imagine being able to buy a property at a 70% discount, often with little or no deposit, and then selling it years later untaxed at its full market value.
But this immense benefit for one generation, it came at the expense of all the future ones.
Because the policy sold off critical social housing stock without requiring its replacement, the numbers are damning. In London, the social housing stock decreased by a staggering 61% since 1980,
61%.
shrinking its share of the housing stock from nearly 30% down to a perilous 10% today.
And furthermore, I saw a study that showed that roughly 40% of those right-to-buy homes across the UK are now just rented out on the private market.
At market rates, which means a significant portion of what was originally affordable housing is now actively contributing to the very housing scarcity and unaffordability it was supposed to combat.
And on top of all that, we have to acknowledge the added pressure of foreign capital.
Yes. London, unlike many comparable global cities, has virtually no legal restrictions preventing foreign nationals from purchasing residential property.
The data we reviewed is striking on this. 27% of residential property sales in London during the first quarter of 2024 were to foreign buyers.
27%. That is an astonishing figure when you compare it to a similar global metropolis.
Like New York,
In New York, for example, foreign buyers account for only 0.3% of residential sales.
0.3%.
That difference, a 90-fold difference, illustrates a very clear policy choice to invite external speculation into a severely restricted housing market.
And this mechanism was compounded by the now abolished non-dom tax status.
For clarity, this status allowed UK residents who were physically living in the UK but claimed their permanent home or domicile was abroad.
To avoid paying UK tax on their foreign income.
Right. The intention was to attract globally wealthy individuals, but the effect was that these individuals just flooded the highest end of the property market. They were competing directly with highly paid local professionals for scarce resources like housing,
Driving prices skyward for everyone beneath them on the economic ladder.
and further concentrating wealth and opportunity in the capital.
Housing is one piece of the puzzle, but the second is infrastructure. Or maybe the chronic and deliberate underinvestment in the rest of the country. The funding gap is a physical manifestation of this regional imbalance.
It truly highlights the priorities of successive governments. London receives nearly £1,200 per person in transport investment,
£1,200. And you compare that to the Northeast.
which gets only £430, and the East Midlands, which receives a mere £350 per person.
That's a disparity of nearly 4 to 1.
The sources indicate that if the North had been funded at London's per-person rate over the last decade, it would have received an extra $140 billion in investment.
$140 billion. That's a sum sufficient to build 7 high-capacity Elizabeth rail lines, linking up major northern cities and creating regional superhubs.
And this chronic neglect, it has tangible negative economic consequences that ripple through the entire national productivity figure.
How so?
Well, the UK is practically unique in Western Europe in that the size of a city does not strongly correlate with its economic productivity.
Which is strange. Usually, bigger cities are more productive.
In Germany or France, larger cities tend to be exponentially more productive because they can draw on a huge catchment area of talent via high-speed regional transport.
Whereas in the UK, weak transport links prevent people from commuting efficiently. They disconnect jobs from potential workers.
And that effectively reduces the economic size of those regional hubs, trapping them below their true potential.
We observe the same reinforcing loop when we look at research and development, or R&D policy.
Yes, R&D expenditure, the key to future high-value employment, is heavily concentrated in high-income areas, predominantly around London, Oxford, and Cambridge.
In 2016, the government spent £60 per person on R&D in London versus only $21 per person in the north. But it's not just a difference in volume, is it?
No, it's a difference in the fundamental principle of the investment policy.
And this is where the UK is a crucial outlier among its peers.
It is. Countries like Germany structure their R&D policy to specifically support poorer regions to help them catch up. The UK's policy does the exact opposite.
It provides more government R&D support relative to the private business R&D already taking place in London than it does in other regions.
This structural favoring deepens inequality rather than attempting to fix it. It creates a self-fulfilling prophecy,
Government R&D money goes to London, so London firms grow faster.
which attracts more private capital and more talent, which then justifies even more R&D investment in London.
Leaving the places that need the foundational support the most with just the scraps.
The system is designed to accelerate the rich and starve the poor. These policy choices, stretching back decades, created an economy built on an unstable foundation, one ready to crumble when the inevitable global shocks finally hit.
Okay, so we've established these deep structural flaws created by policy. Now, let's discuss the consequence of those flaws meeting geopolitical reality after 2008. The stagnation that followed the financial crisis is, I think, rightly described by the sources as the lost decade for ordinary citizens.
This is perhaps the most crucial context for understanding the current social unrest. Since the 2008 global financial crisis, real disposable income.
And that's the money households have left after taxes, benefits, and inflation.
Correct. That has remained almost completely unchanged for the vast majority of citizens. We are talking about 15 years of flatlining prosperity.
The peer comparison is deeply troubling here. In 2007, British households were only 6% less prosperous than those in the US and 8% behind Norway, which is a wealthy oil-producing nation.
Today, following that lost decade, they are 16% behind the US and a massive 20% behind Norway in real income terms.
So that deficit grew exponentially post-2008.
It did. And this drop in relative living standards stems directly from the policy choice made following the GFC. After the government borrowed heavily, roughly $141 billion, to bail out the global banking sector headquartered in London.
The subsequent decision was to implement severe austerity measures.
Instead of prioritizing fiscal investment or strategic tax cuts or job creation programs in the regions that had been abandoned by manufacturing,
The sources suggest the government essentially prioritized stabilizing corporate finance and balancing the books over immediate support for the flatlined household incomes of ordinary citizens.
the burden of recovery was placed disproportionately on public services and household budgets.
And even those corporate gains were short-term because the fundamental driver of long-term economic health productivity was left on the back burner. Another critical consequence of the lack of investment and austerity post-2008.
We should probably clarify productivity because it's often misunderstood.
Yeah, improving productivity doesn't mean working harder.
Not at all. It means boosting economic output without increasing the amount of labor input. It's a structural change like switching an agriculture-driven economy to one manufacturing complex microchips.
Or investing in automation to allow fewer workers to produce more high-value goods.
Exactly. It's about increasing output per capita by shifting to higher value, more profitable industries and improving efficiency. But due to the lack of capital expenditure and strategic investment following 2008, productivity output severely debilitated.
It halted a growth trend that had been in motion since the 1980s.
And the effect of this halt is stark. The British workforce now has the second lowest productivity rate among G7 economies.
And before 2008.
It was second only to the United States. That is a tremendous and worrying reversal in global economic standing that directly correlates with the stagnation of household wealth.
This combination of flatlined incomes and stalled productivity really explains why the UK economy is characterized as fighting for its life.
And this struggle, because it was often ignored or mismanaged by politicians for so long, started to erode something even more intangible but critically important.
National confidence.
National confidence. It's the bedrock upon which any stable economy is built. Once that confidence is lost, it causes real tangible damage because capital is inherently shy.
And we can trace the start of this long-term damage to the UK's reputation for stable management back even before the GFC.
Right back to 1992.
Black Wednesday.
Black Wednesday, September 16th, 1992. The UK was forced out of the exchange rate mechanism, or ERM.
For those who don't remember, the ERM was a system designed to link the major European currencies with agreed-upon exchange rate ranges.
Theoretically, it was to eliminate cross-border risk and provide stability ahead of a planned monetary union.
But Germany, grappling with the immense costs of reunification, was forced to raise its interest rates dramatically to attract global investment.
And this pulled vast amounts of global funds out of lower-rate countries like the UK, whose central bank was mandated by the ERM to keep the pound within a narrow set band against the Deutschmark.
So the Bank of England was forced to intervene.
Selling off huge quantities of foreign currency reserves to keep the pound artificially high. But their desperate attempts to maintain the commitment failed spectacularly against massive speculative pressure.
And on the day of the collapse, the Bank of England raised interest rates from 10% to an astonishing 15%.
Before admitting total defeat and lowering them back to 12%, all within a single frantic day.
That failure, more than any other event, it shattered the post-war perception of the UK as a supremely well-managed, financially sound economy.
That reputation, once as sound as the pound, was damaged. It was replaced by a narrative of instability and vulnerability to external market forces.
And that initial doubt has just been relentlessly compounded by subsequent high-profile events.
The global financial crisis, which exposed the over-reliance on the financial sector, the years of political paralysis following the Brexit vote.
In the now famous revolving door of prime ministers.
Each event reinforces the narrative that the UK is suffering from deep political and economic mismanagement.
And the economic consequence of this lack of consistency is very real. Uncertainty means that long-term investment, complex trade deals, capital deployment, they're all viewed as far riskier propositions now.
Even wealthy domestic residents and foreign investors are choosing to invest their money elsewhere.
And we see this reflected in the foreign direct investment outflows.
The gap between FDI outflows and inflows in the UK is now at its highest level since the GFC. The money isn't just staying home, it's actively seeking more stable, more predictable jurisdictions.
When the domestic pension funds start selling their holdings, you know the crisis of confidence is truly severe.
Which brings us to the sequence of recent back-to-back shocks that violently escalated the UK's pre-existing structural debt problem. This really starts around 2016.
First, we probably need to contextualize the debt itself. The UK currently holds $2.9 trillion in debt, which now exceeds its entire annual economy.
And for centuries, the UK was a uniquely trusted global borrower. It financed post-war rebuilding, the welfare state. Crucially, that historical trust in repayment kept borrowing costs incredibly cheap.
But the three massive back-to-back shocks that started in 2016 dramatically altered the debt landscape and the perception of risk.
Shock 1, Brexit uncertainty. The vote itself was only the start of the financial chaos.
The political saga that unfolded after the 2016 referendum, David Cameron's resignation, Theresa May's repeated failed attempts to pass a deal.
The constant deadlock over the Irish and Northern Irish border, and just years of bickering and delays.
All of that created massive, sustained uncertainty costs for businesses. Investment dried up because nobody knew what the rules of trade would be.
And the sources confirm the economic damage of this political chaos. Brexit uncertainty reduced foreign investment by a substantial 25% between 2016 and 2021.
And even the final trade deal, which allowed for free trade and zero tariffs, still implemented severe restrictions on the free movement of labor and complicated the movement of goods across the Irish Sea.
Which incurred high administrative costs for businesses. So that fragility, combined with the onset of the global pandemic, led to shock 2.
The COVID intervention.
The government borrowed an additional $280 billion for the pandemic response, funding the furlough schemes, business bailouts, and stimulus spending that kept the country afloat during lockdowns.
And crucially, most of that staggering sum was borrowed when interest rates are at historic lows, often around 0.1%.
At that rate, the debt looked manageable. The plan was to grow the economy out of the debt.
But that calculation was based on a benign, low-inflation world that was about to disappear entirely.
The final nail in the coffin was shock 3, the Ukraine war and the ensuing energy crisis. Global sanctions immediately halted Russian oil and gas access to Europe,
triggering a rapid and severe spike in the cost of living and energy prices across the continent.
The UK government felt compelled to respond with one of Europe's most generous support packages, ranging between 60 billion and 100 billion in additional spending to shield households from soaring energy bills.
This intervention was necessary for social stability, but it pushed up national debt and inflation significantly, directly compounding the previous two shocks.
And in response to that inflation surge, central banks worldwide, including the Bank of England, aggressively ramped up interest rates in a very short time frame.
This action trapped the government in a severe fiscal dilemma.
Higher rates caused mortgage payments to soar for households, but critically, they made the national debt exponentially more expensive to service.
The resulting jump in the debt servicing cost is absolutely staggering, and it's central to the UK's current policy paralysis. The cost rocketed from roughly 40 billion per year to an astonishing 100 billion per year.
Almost overnight.
That is a colossal 60 billion increase in annual spending.
To help visualize that number, it's nearly the equivalent of the entire British defense budget.
The debt interest bill is now the country's second largest item of public spending, behind only the National Health Service.
And think about the implications of that jump. This is 60 billion that is now entirely unavailable for investment in schools, infrastructure, regional leveling up, or the NHS.
The very services that are desperately needed to improve productivity and life expectancy outside London.
The spiraling debt cost directly depreciates the quality of every other public service, accelerating the social crisis. This vicious sequence of geopolitical shocks hitting a structurally weak, unequal, and highly indebted economy explains the rapid financial deterioration and the sense of powerlessness we are seeing today.
Beyond the staggering debt servicing cost, we need to look at the deeper social consequence of this economic stagnation. And that manifests as a fundamental problem in the labor market, the missing workforce.
This is a paradox that's often overlooked when people focus only on the low official unemployment rate.
Right.
Unlike almost every other advanced economy that saw a surge in its workforce after COVID lockdowns subsided, Britain's workforce simply never recovered. It has remained persistently low compared to its G7 peers.
The official unemployment rate is low by historical standards, around 4.4%. But that masks a huge reality.
A huge reality. The nation is missing a staggering number of potential workers. The government classifies 9.4 million people as economically inactive.
Meaning they're neither actively looking for work nor available to start a job.
And the composition of this inactivity is where policymakers face the greatest challenge. About 2.1 million aged 16 to 24 are students, which is normal.
But more concerningly,
3.5 million people over 50 years old are out of the workforce due to sickness, often chronic illness, and early retirement that was accelerated by the pandemic.
and we have to add another 1 million people aged 25 to 49 who don't work due to increased caring responsibilities.
Often related to family members who are sick or aging. This is a severe and persistent structural issue.
A workforce that is essentially missing 11 million people creates massive fiscal and economic ripple effects.
It means less tax revenue flowing in to pay for essential services like healthcare and debt servicing.
And simultaneously, it necessitates greater expenditure on social benefits and pensions for an aging and increasingly unwell, inactive population.
Businesses, needing to maintain operations regardless of this domestic shortfall, put tremendous pressure on the government to find labor.
So the policy choice to offset this difference has been to allow massive numbers of new workers in, what some sources call the immigration offset.
This choice resulted in a rapid, large-scale influx of migrant workers, predominantly from South Asia and Sub-Saharan Africa, filling the labor gaps left by the reduced domestic workforce.
It was the fastest way to stabilize the immediate labor shortage.
But here lies a strange and worrying paradox for long-term productivity.
What's that?
While the UK is attracting low-skilled migrants to fill these immediate gaps in areas like care and logistics, it is simultaneously losing highly skilled, high-value workers.
Doctors, tech professionals, engineers, specialized academics.
Who are migrating to places like the USA, Canada, Australia, and Asian financial hubs.
And this trend of losing highly skilled workers has been in motion since 2007.
So the net result, while positive in terms of overall population gain for now, is a net skills deficit for the future economy. It's a short-term fix with potentially severe long-term consequences for high-value output.
And this rapid, large-scale influx of immigrants, which has resulted in some of the highest net migration figures in decades, has raised significant and volatile social tensions within the nation.
Especially in the regions that already feel economically neglected.
The sources noted that people feel threatened by the changing demographics, often leading to a sense of resentment that is frequently exploited by politicians for short-term political gain.
This tension escalated dramatically in early August 2024 when anti-immigration protests and riots rocked over 20 towns across Britain, illustrating the severe social instability bubbling just beneath the surface of the economic crisis.
This combination of structural economic decline, stagnation, and policy choices that prioritize short-term labor needs over long-term stability has created a cycle of fiscal dependency and social tension that will take far longer to resolve than any single easy policy adjustment.
Which brings us to the culmination of our analysis. The current political paralysis created by the debt crisis and the profound lack of viable options. The UK is facing a severe policy dilemma where all doors seem to lead to political pain.
The immediate danger isn't just the overall debt number, it's the financial structure of that debt.
Right. The UK has dramatically shortened the term structure of its national debt. Historically, only 6% of the national debt was due within a short-term window.
And today?
Today, that figure is 27%.
That's a huge shift. And it means the government is highly exposed to immediate interest rate hikes.
Higher rates hit the government almost immediately, forcing continuous, expensive refinancing of massive chunks of the debt at whatever the current higher market rate happens to be. Unlike the U.S., which typically locks in debt for decades, the U.K. has chosen vulnerability.
And the vanishing trust is evident, even among traditional buyers of UK government bonds or gilts.
Domestic pension funds, historically the absolutely reliable backbone of the economy and the primary buyers of government debt, have cut their holdings of British gilts by almost 40% since 2021.
That is an undeniable, tangible sign of waning confidence.
And it forces the government to rely more heavily on foreign investors, who are now demanding significantly higher returns, meaning higher interest costs, due to the perceived instability and increased risk.
The fundamental problem is that the government currently faces a massive funding gap. It spent $152 billion more than it earned last year. To close that gap and restore stability, the government faces three agonizing, politically impossible choices.
Option 1, aggressive cutting of spending or austerity.
In theory, it's the simplest path. Spend less, borrow less.
But politically, it's explosive, potentially socially destabilizing. To make meaningful cuts that actually close a $152 billion gap, the government has to target massive commitments like the NHS, welfare, and crucially, the triple lock on pensions.
The triple lock guarantees that pension payments rise by the highest of three measures: inflation, average earnings growth, or 2.5%. This is politically sacrosanct for millions of older voters.
Touching those huge social commitments would be politically ruinous. It would reinforce the already widespread idea that nothing works anymore in Britain and deepen the social crisis.
Okay, so then option 2. Raising taxes significantly.
The problem here is that the UK is already one of the most heavily tax-developed economies, with the tax burden currently at its highest level in 70 years.
Raising rates further risks choking the already stagnant economy and squeezing households already struggling with the generational cost of living crisis.
It's an economic catch-22. You can't tax a recovery into existence.
And then there is option 3, the riskiest path of all: quantitative easing, or QE, used simply to cover existing bills.
Creating new money to buy up government debt. This is often the desperate option of last resort.
Why is it so risky?
Well, while QE might stabilize the market short term, it would pour immediate fuel onto inflation. More importantly, it would absolutely destroy centuries of the UK's hard-earned reputation for financial discipline and fiscal probity.
So if the Bank of England is seen resorting to creating money simply to cover existing government deficits,
foreign creditors might instantly dump their holdings of British debt on a massive scale.
a mass dumping of gilts would cause bond prices to plummet, sending borrowing costs for the UK government through the roof and accelerating the debt spiral into a full-blown crisis.
It's a reputational bomb that would severely undermine the country's global standing.
And we don't have to speculate about what happens when this confidence breaks down. We have the recent terrifying cautionary tale of the Liz Truss mini-budget in 2022.
That plan sweeping unfunded tax cuts based on supply-side theory was precisely the worst possible signal to investors already nervous about the UK's direction.
Confidence didn't erode slowly, it collapsed overnight.
The pound plunged to a record low against the dollar, and crucially, bond yields, the rate the government has to pay to borrow, rocketed up. This sharp movement created a vicious cycle that almost broke a specific, crucial part of the financial ecosystem.
Pension funds.
Yes. We should probably slow down and explain that specific mechanism. Many defined benefit pension funds use complex investment strategies called liability-driven investment, or LDI.
They use government bonds, gilts, as collateral to manage their long-term liabilities.
So when the price of those bonds suddenly plunged due to the market panic over the mini-budget, the collateral value of the pension fund's holdings also fell instantly.
This triggered margin calls.
Demands for immediate, massive injections of cash to cover the deficit. If those funds couldn't raise the cash fast enough, they would have been forced to sell off assets indiscriminately, leading to catastrophic insolvencies.
The panic lasted only weeks, but it forced the Bank of England to intervene, not to stimulate growth, but simply to inject billions into the market to stabilize bond prices and stop the pension system from physically breaking down.
That event provided a sobering, immediate lesson. Confidence can unravel overnight, and that fragility, built upon decades of structural policy choices, is now the UK's defining characteristic.
And unlike countries like Greece or Italy during the Eurozone crisis, the UK has no external safety net like the EU to fall back on.
A crisis in the UK would be unilateral, striking at its long-standing claim as a pillar of global stability.
What a deep dive into decades of structural choices meeting catastrophic global events. The narrative seems clear. The UK's current crisis is a complex, almost violent interaction of deep, endemic structural flaws,
Regional inequality, acute dependence on financial services, and stalled productivity.
amplified by the back-to-back geopolitical shocks of Brexit, COVID, and the Ukraine war.
The crisis is fundamentally a matter of prioritization. For decades, policy favored the concentration of wealth and opportunity in a single region over the equitable distribution of prosperity across the entire nation.
Leading directly to the fragile two-speed economy.
And when the shocks hit, that fragility was immediately exposed, converting a stability problem into an acute debt and social crisis.
We should acknowledge the positive counterpoint, though. London remains a powerhouse, wealthy, and innovative. And the country still holds the foundational ingredients for prosperity.
Excellent universities, legal stability, a deep culture of entrepreneurship. Every developed nation goes through cycles of ups and downs.
But the challenge facing the UK is no longer purely economic.
It is fundamentally political and social. Until policy can successfully spread opportunity, investment, and infrastructure funding beyond the few square miles along the Thames and restore consistency and predictability to governance.
The UK risks losing its hard-earned reputation as a global pillar of stability.
It truly makes you wonder about the long-term political sustainability of this position.
Given the immense short-term political costs of serious fiscal reform, touching the triple lock, cutting the NHS, raising taxes further, how long can a democracy afford to delay the pain necessary to secure its long-term financial and social stability?
That is the ultimate test of political leadership and national resilience, a thoughtful question to end on.